Hello guys, welcome to another video. Here is TTG, and we're gonna be talking about a bit of a different topic today. Today's topic will be journaling. If you haven't heard of journaling, you're definitely doing it the wrong way. Um, as a trader, you've got to journal all your trades. So basically, I'm gonna break it down for you. The first thing you need to do is to learn how to trade. It's a normal answer from anyone you get, but you've got to learn how to trade first. Once you get to know the game a bit further, you have to journal what you've learned. The reason being, let's say for example, you've been making few mistakes, yeah, and one day you woke up and you're like, you know what, I want to learn from my mistakes and I want to move forward in a positive aspect. Um, but obviously, you don't have your mistakes journaled or saved or written. Therefore, you can't really learn from your mistakes, can you? And that's why we journal. So for every trade you take, you have to journal it. Either when you are backtesting, either when you're live trading, it doesn't really matter. But backtesting is the pinnacle of trading, as well as journaling. So backtesting, journaling goes hand to hand together. And I would say to you that you need to start with journaling. So while backtesting, you need to journal. While trading, you need to journal. While you're demo trading, you need to journal. As well as while you live trade, you need to journal. The reason being, as I said, if you want to fix a mistake, you've got to go back to it, watch it, see where you made the mistakes in order for you to learn and come up with a solution. And for that reason, you need a journal. And today I'm going to be showing you the principles of how I built my journal, as well as how you should build yours. It's basically five or six main points that you need to have in the journal in order for you to learn. But I will be talking about them today. So first of all, you need to open an Excel sheet. So let's open one here, just as an example, so you can get an idea. As I was saying, it's basically you need to create an Excel sheet. This Excel sheet will be your journal eventually, and that's the goal. That's what you should do. But I will walk you through the Excel sheet. What is the criteria? What you should put there. I believe that journaling is the pinnacle of trading. It's literally the pinnacle. That's what works for me the most, because you need to be able to see your mistakes and what you've done in the past in order for you to improve the future. I'll just leave it like that. But I will show you the Excel sheet and what to put on it. Right. First of all, it's the pair. You need to know the pair. You cannot trade without knowing the actual pair you're trading. Is it UUSD? Is it GBP USD? Is it GJ? Is it gold USD? Is it silver USD? You need to be able to identify what you're trading. And without direction, there's no point of you trading. The second one, date. What date, on what day you executed the trade. Third one is timing. The time of where you executed the trade. And that will basically give you an idea on an example of what sessions you pretty much trading. The direction will be either bullish or bearish. Either the market is buying or selling. The action is pretty much, what did you do? Did you sell? Did you buy? A probability based on the pair, the date, the time, the direction, and the action. What was the probability of that trade? Was it a high probability setup, or was it a medium probability setup, or was it a low probability setup? Stop loss size. Stop loss size is quite important. For example, let's say over a period of 20 weeks, most of your trades were between 17 to 20 pip in terms of the stop loss. And one day or 2 days or 3 days, you took few losses and the stop loss was over 20. From that, you start identifying if the stop loss of a trade that is higher than 20 pips, is it beneficial for you long term or not? And you start tracking it in the journal, you see the probability of it, and eventually you can limit it eliminate it, increase it or decrease it based on what you see fit. Percentage. As I call myself a percentage trader, it is very, very important for me to know if it's a loss or a win. Because if I don't know if it's a loss or a win, how much percentage is generated to me, there's no point of executing the trade in the first place. And the last one, on why the journal was created, is to see the trade itself. Because you can have everything written down, but if you can't visualize it, you can't see it with your own eyes, you're most likely not going to be able to fix it or learn from it. The last one is the link. It's basically a screenshot from TradingView or whatever platform you're using. That screenshot will provide you with a picture of the trade itself, the setup itself, and the market itself, and that over a long period of time, you'll be able to identify it yourself without the need to look at it. So I'll explain to you each column on why it's important. All right, we'll start with the pair first. Here we are, pair. Let's say, for example, Euro USD as a pair. Date could be, we are the 25th today. Today is Wednesday, no, Thursday. So we'll do Thursday, 25th. Done. Time, based on the time you took the trade. If you're taking a trade at 9, you write 9. So let's say 9 a.m. Direction, if the market was bullish or bearish. Let's say, for example, the market was bullish when we took that trade. Action, did you buy or sell? Some people would be like, why would you sell if the market is bullish? And I will answer you with this. Um, you try to short the market short term. You try to sell it short term in order for you to benefit from both moves, short term selling and long term buying. And that's why sometimes selling in a bullish market is a wise move. If it's tracked properly, you follow it with the right mindset and the right technique, it could generate you some serious percentages. So action, let's say buying. Probability, let's say based on the direction, the date, the time, and the action, the probability was high, for example. How do you know if the probability is high or medium? It's when you start journaling for so long, you start picking which trades, which setup is high or medium. High means it happens a lot and it works well, and when it happens, it works. And when and medium probability is basically it happens and it doesn't work all the time. If that makes sense. Stop loss size. It's basically when you're taking a trade, you have an entry point, stop loss under it, and take profit above it, or vice versa if you're selling. Say stop loss, for example, 20. If you are tracking the stop loss, that means every time you're taking a trade, you going back to your journal and seeing for the past, for example, year, you've been taking trades that have a stop loss of 20. However, the trade that presented itself at the moment have a stop loss of 30. So you know what? So when you try to make that decision, you're like, is it a wise move? Should I do it? Is it smart? But if I've been doing 20 pips for the past year in terms of stop loss, why am I going to do 30 pips on this one? Then you dodge it. You don't take the trade. That's the beauty of journaling. But if you don't have the journal to go back to and compare, you'll never know. You just keep rolling, rolling, rolling. It's like a snowball effect. You pushing the ball and it keeps growing, 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 but you don't know what's happening in the ball. It just keeps, the same effect. And that's where the snowball theory comes through. You know what I mean? So stop loss, yeah, percentage. For me, I only aim for 3% percentage for each trade. 1% loss, 3% win. Keep it very simple. It works over long term, and I don't want more or I don't want less. If my trade is hitting 2.9 and about to hit TP, guess what happens? I don't close it. Even if I reverse and go back as -1 and hit my stop loss. It doesn't really matter. If it doesn't hit 3%, I'm not out of the trade. Link is basically the link from TradingView. I'll show you how to generate the link from TradingView to have the setup saved there. All right, I will show you now how to generate the screenshots from TradingView. So basically, this is TradingView. You go to this icon here or emoji, you press on it, you press on copy link, you go to the sheet and you paste it there. So once you take that, yeah, you copy it and you paste it somewhere here. It will give you the same screen as here, and that's how you track your trades. And you've got to see your trade, you've got to learn from them. This is why journaling is very important. This is why this video is one of the most important videos that I'm gonna upload, because it did help me massively. When you don't have a journal, you pretty much, I would say, walking through a storm without without a coat on, or walking through a tunnel and you're blind. It's not that difficult. It's not that easy. It's gonna be difficult. Um, and you're eventually gonna learn, but instead of taking a year or two to learn from the mistake, you might take 4 or 6 years to learn from the mistakes. That's why journaling is very crucial in your career. I think this is it, guys. I think this is gonna be the end of this video. It was quite brief. I explained why it's important. I explained every element of the journal, how it's gonna affect your trading. And yeah, good luck with 2026. Good luck to us all. It's gonna be a very, very interesting year in terms of trading. With Trump becoming president, we'll see big movements in the market. It's gonna be an interesting year. But I wish you all the best. Thank you for watching today's video, and I'll catch you in the next.